Hello and welcome to our weekly webinar, or one of our weekly webinars here today at Advanta IRA, talking today about investing in self-storage during an economy of change. Self-storage is definitely a very hot investment in real estate side. I've heard a lot about it over the last year or so, and excited to have a guest speaker on today who's going to talk about self-storage in particular, and kind of looking at it from that investor point of view. So I'll bring Kris on in a little bit as we get going through the presentation today. Again, I'll remind everyone who's listening live to the webinar, if you have questions for us, either myself or for Kris as we go through the webinar, please type those into the question box on your screen. I'll make sure I get to those, get those questions asked of Kris. We'll have certainly ask some questions as we go along and have some time at the end. So make sure you get those questions into the box. My name is Scott Maurer. I'm the Director of Business Development here at Advanta IRA, and will be your host today in presenting, obviously this on self-storage and possibly even using your IRA to make that type of investment. I've been with the company, for those of you who are unfamiliar with me, I've been with the company since 2006, coming up on 15 years here with Advanta IRA in a little while. I'm also a licensed attorney. I don't do any legal work on behalf of Advanta clients. That is my educational background. My contact information is here on this screen. It'll be at the end of the presentation as well. If you have questions about self-directed IRAs and some of the few things that I will cover, please don't hesitate to reach out to me either by phone or by email. I do want to share, as we do with every presentation, our disclaimer, and that Advanta IRA does not provide investment or legal or tax advice, and we don't endorse any particular products or investments. So we have a speaker on today who's going to be talking about self-storage, and obviously they're a company that does self-storage investments. It's still up to you to do your due diligence on anyone you choose to invest in, whether it's related to somebody you heard on a webinar or not. The burden of performing your due diligence and being comfortable with the investment you make does fall to you as the account holder if it's your IRA account. So the information we're presenting today is for educational purposes. If you do want access or a reference or referral to an attorney or CPA, we can certainly contact us and we can refer you to someone familiar with self-directed IRAs to help you out and give you that level of information. Just a quick background on our company. We've been around for almost 20 years. We have over $1.5 billion in assets spread across two different offices that we have, one in the Tampa Bay area, one in the Atlanta area. We really specialize in the customer service experience we offer to our clients. And we place every account holder with a dedicated account manager for their account. So you call into Advanta IRA, you have one point of contact for anything you need regarding your account. Just very briefly, kind of self-directed IRAs and what self-directed accounts are. I'm assuming most of the people on this call are already familiar with self-directed IRAs, and essentially a self-directed plan is a retirement account basically that allows you to choose the type of an investment that you wish to make within your plan and with your cash, rather than being limited to mutual funds or stocks or different types of brokerage assets that you're going to find in accounts with a Fidelity, a Schwab, a Morgan Stanley, where they limit you to only those products that they sell. But with a self-directed IRA, you can do so many more different things I'll talk about in just a moment. But the types of accounts that can be self-directed include any type of IRA, your traditional, your Roth account, a SEP or a simple. If you're a small business owner, the SEP and the simple IRA offer you the ability to contribute more money on it in a given year. Any former employer plan, if you have an old 401k or an old 403b, old 457 plan, or maybe even an old TSP plan from the government, those accounts, once you leave your employer, those monies can also be rolled over into a self-directed IRA, and then in turn, used to make the types of investments we're talking about today and that we talk about on a lot of our webinars. We also have HSA and ESA accounts as well, which aren't retirement accounts per se, but they follow the same rules that we're going to talk about here in just a moment. And as I mentioned, with the brokerage account, with most kind of conventional IRAs, people are limited to mutual funds, stocks, and bonds, only those publicly traded securities. But with a self-directed IRA, there's so many more different things you can invest in within your particular account. We see all types of real estate, whether it's residential, commercial. Obviously, we're talking today specifically about self-storage as an investment in the real estate realm. We have people invest in cryptocurrency, private equity, precious metals, private lending instruments. The key thing, and then the point at the bottom of the slide, your agenda, those things that you are familiar with, that you're comfortable with, that you know the most about, most likely you could invest in that using your IRA account. There's only a very few investments and restrictions the IRS has placed on IRA accounts when it comes to making an investment. And that is, you can't buy two types of investments, basically life insurance and collectibles. It's the only two investment types that you cannot buy within a self-directed IRA account. And your collectibles would include your antiques, artworks, and certain coins. And the IRS restricts you from using your IRA to transact with or benefit a disqualified person. You can see the disqualified persons are on the right side of the screen. Includes yourself, your spouse, your parents, your grandparents, children and grandchildren. Those individuals were all disqualified from doing a direct transaction with your IRA or receiving any kind of benefit. So from a real estate perspective, you cannot buy a house that you or one of those individuals is going to use or going to live in, vacation, and et cetera. It's got to be strictly for investment purposes. Now, one of the benefits, obviously, of today's topic, when talking about self-storage, but the only way you would violate the IRS rules by using your IRA account to invest in self-storage is if the person who is running the self-storage investment or running that particular fund, if that person is disqualified, then your IRA, you couldn't invest in it. So a parent could not invest in their child's self-storage investment fund. But outside of that, you're not going to find any real restrictions come into play with this type of an investment. And again, as you'll find out during the presentation, a lot of the self-storage investments very similar to other commercial investments, commercial real estate investments, and also the multifamily space that we've talked about quite a bit on our webinars as well. A lot of times those investments are structured as a private fund. So you'll see private funds with a lot of different strategies. There's hedge funds, again, commercial real estate, multifamily, or we'll talk about, say, self-storage funds that you could invest in. So it could be small syndications, with just a few people. It could be much larger, more diversified. But these funds are structured for individuals to each use a portion of their retirement account to kind of come together, create a bigger pot using a number of different investors. Not many people are going to have enough cash or available resources just to go buy their own self-storage facility without help from outside parties. So by using a syndication or a private fund, it allows you to bring other investors into your whole pool and make those larger purchases. It is important if you're investing in a private fund that you understand the rules on either accredited investors or being non-accredited, depending on how the fund is set up. You might have to reach certain benchmarks of either net worth or annual income to qualify as an accredited or not accredited investor. And again, when you're investing in a private funds, make sure you understand how transparent you're doing your due diligence on the investors themselves, the people who are running the fund, and understanding the returns. Some funds are set up in some ways where you get a monthly or quarterly dividend. Others, the returns you get are more set at the back end of your investment. So make sure you understand that going in. Again, that's something that Advanta IRA does not do their due diligence on. What we do is if you want to invest your IRA account into a private fund or a private real estate deal, our job is to make sure that the investment documents, the subscription documents, get completed properly in the name of the IRA and make sure you've approved of it. But deciding whether or not it's something you should get involved in or not, that is completely up to you. We make it pretty easy to get started if you're looking to use your IRA. Filling out an account takes no more than 15 minutes. You can fund your account either by transferring money from an existing IRA or doing a rollover from those employer plans that I talked about earlier, the 401ks, 403bs, etc. And then for us, the third step, finding the investment, telling us what it is that you want to use your IRA funds to invest in. And quite often, a lot of clients come to us already at step 3. They know what they want to invest in. They've come across a great opportunity, but they're deciding to make this opportunity, make this investment inside of an IRA. So we help them get established and get that fund and get that account funded. In addition to our customer service experience, we're also big proponents of education. So the webinar that we're listening today, or you're listening to today, is an extension of that. We currently not do any live seminars, but we certainly have a lot of live webinars, networking events to really help people learn about self-direction and obviously about topics related to self-direction. That's why we brought a guest speaker in today to talk about self-storage. I am by no means any kind of expert or have any knowledge base really on self-storage, so we're bringing someone else in to talk about that. You can always watch any webinar. If you miss one on our video library, go to our Advanta On Demand channel, our YouTube page. All the webinars we do are recorded and are placed there for later playback. And then before I bring on our guest speaker here in just a minute, I wanted to make sure everybody's aware of one other event that we have. We call it our Pitch, Promote, and Prosper event. It's an event where we typically have to be careful about letting people promote their investments, but this is one marketplace and one form where it is permitted. We typically host these every other Friday or so. You can go to the link at the bottom of the page here, advantaira.com/event/pitch-promote-prosper. It's a place for you to come in and network. If you have an asset or an investment you're looking to sell, you're looking to buy, you want to meet other people who have different types of investments, this is the place to come. You're allowed to come in. We give everybody a chance to introduce themselves and kind of throw out what they're looking to buy, we're looking to sell. We usually get at least 50 to 60 people on each of these events, and they're from all over the country. So you get exposed to a lot of different people, a lot of different kinds of investments as well. But at this time, I wanted to get to the meat of the presentation and kind of what everybody is here for. Presenter today, our guest is Kris Benson with Reliant Real Estate Management LLC. He's going to talk about how to invest in self-storage, what's involved investing in self-storage. So I'm turning over the controls here to Kris for him to bring up his slides. And as he's bringing those up again, I just remind you, if you're listening to today's presentation live, if you have any questions, please type them into the question box. I'll make sure Kris gets to those again, whether during the presentation or at the end. And if you're someone who's listening to the recorded version, obviously Kris's information will be here on the slides as well for you to reach out to him. But Kris, how you doing today?
I'm doing fantastic. You guys hear me okay? And does it look okay on your screen?
Yep, coming through just fine. Hear you loud and clear. So actually, here before you get started, Kris, we actually had a question pop up. Someone said, upon rollover of a TSP plan to a self-directed IRA, is that considered income on a tax return? So I'll just answer that one right off the bat. When you roll over money from an employer plan like a TSP or a 401k to an IRA account, it is not taxable to you at all. You're moving it from like account at the TSP to a like account at an IRA account. So you should have no tax considerations whatsoever on moving that money over. So that's the advantage of using a self-directed account, is you're allowed to move that money from those accounts into a self-directed IRA, no tax consequence, which enables you to take advantage of the investments that we talked about a minute ago and we're going to talk about today. So again, great question. Keep those coming. And Kris, I'm going to turn it over to you. If anyone has questions, please type them in and we'll make sure we get them asked.
Sounds like a plan. Well, I appreciate you giving me some time this afternoon. Appreciate those who joined on the webinar. We'll hope to make this an educational event for all. And I would encourage you, as Scott did, to throw your questions through the chat box, and we'll try to make this as interactive as we can. If there's something I'm going through that would be helpful for some additional clarity, please let me know. To Scott's point, I'm Kris Benson. I'm the Chief Investment Officer for a company called Reliant Real Estate Management. We are a vertically integrated self-storage operator, so that just means we're buying and managing the self-storage properties that we own across the Southeast. I'm talking to you from our office in Roswell, Georgia. So we're just north of Atlanta, about 20 miles. And the goal of today is really to give you an introduction to, for those of you not that familiar with real estate as an asset class, we'll give you an introduction to real estate, why we think it's a great asset class to invest with. And just to kind of pile on to Scott's conversation around self-directed IRAs, I've also used my self-directed IRA for a lot of real estate investments, both within Reliant and outside. It's a great vehicle to be able to control your own destiny. And it's amazing how many people are not aware of the benefits of self-directed IRAs and have their 401k or IRA or self-directed 401k locked up with a traditional platform. So I'm a big proponent of that. And we'll talk about why we think real estate may be a good asset class for you to consider. And then certainly dig into self-storage, the trends in self-storage, what we've seen on a historical basis, and then also opportunities for the future and the growth around the asset class. And then certainly many of our investors have asked us how we've done during COVID-19. We'll talk about some of the trends in the industry and what we see moving forward across the board. And as I had mentioned, and to reiterate what Scott said, please utilize the chat box. We'll try to make this as interactive as possible. So if questions pop up, we can get to them. Just a brief introduction to us as a company and giving you some insight into our experience. Traditionally, or currently, we have 50 properties in our portfolio, primarily across 8 states here in the Southeast. That's where we focus most of our efforts. That portfolio represents just over 31,000 units, 4.1 million net rentable square feet, and a portfolio valuation of just over $370 million. We have about 130 employees, kind of depends on the day, about 15 of us in our corporate office here in Roswell, and then the majority of them are out in the field running our facilities. We've also had a pretty substantial exit track record. So we've sold 22 properties, and what we're showing here is the project level returns on those properties themselves. And so we've taken a number of properties full cycle. We've never lost investor principal, and we believe there's still significant value in the marketplace. Happy to answer questions. In this deck, I'm sure Scott will make available for you to download. I'm not going to go through it, but this is each of the 22 properties with their particular return profiles. You know, what I'd like to focus on, and we talk about a lot, you know, real estate investing is a complex business for sure, but what you're really investing in is the people behind the real estate. And at Reliant, we have a great team. This is some of the senior managers on both the founders, Todd Allen and Lou Pollack, and then also both operations, construction, and our acquisitions team. And so we work really hard to pull together some great projects and continue the growth Reliant has experienced. You see my picture there, but certainly I'm standing on the shoulders of the rest of the guys who make up the team when I talk about what Reliant has done. So let's dig into why real estate. I think there's really 3 things to think about when you think about real estate as an investment asset class, and why you should consider it in your portfolio. You know, many of our investors want to always talk about historical performance and the rate of return, which is certainly understandable. So we'll dig into a little bit of some data on historical performance of real estate versus some other asset classes. Also tax advantages of real estate and some of the benefits that you can derive from investing either with your qualified funds, your self-directed IRAs, or through a cash position. And then finally, let's touch base on the correlation that we see between real estate and some other asset classes. Many investors come to us with the idea that they're trying to get some diversification across or away from the traditional equities market. So we'll look at some of the correlation between real estate and some more traditional investments. But let's dig into the returns first. And look, I am by all means a proponent of the idea that data can be made to say whatever you want, ostensibly. If you get enough data, you can almost form any story out of it. And so it's not a silver bullet by any means, but what I'm sharing with you is an interesting paper that we've uncovered. It was done by a group of researchers, and the paper was actually published by the Fed Reserve Bank in San Francisco. And if any of you guys want, it's called The Rate of Return of Everything. We can send you the link if you reach out to us, or the document itself. Scott, I'm not sure if you can add that to the download page for the webcast, but we can certainly get it to you. But what's interesting about it is they look at data across 145 years, from 1870 to 2015, across 16 countries, including wars, but excluding some of the hyperinflation periods that we've seen so that we don't skew the data. And what they were trying to answer the question of was, what is the aggregate real rate of return of an economy? And what assets have had the highest long-run returns? And so, I'm not going to get into the nitty-gritty on the data here, but what you're seeing is bills, bonds, equity, housing, which we're considering real estate, in real returns and then nominal returns. And what you can see with the summary table in Figure 2 is across that 145-year period, residential real estate, not the traditional equities, has been the best long-run investment in the course of modern history, right? And so This is just an interesting data set across, and probably the largest I've seen, not only across the period of time, but also multiple modern economies, not just the US. And so the second part that I think is interesting, if you look back, and I'll jump back and forth just really quickly on table 3, is the standard deviations for real estate versus equity are substantially lower. And what that means is the volatility or risk associated, the ups and downs on housing, were much lower than traditional equities. And so although the returns are around the same, the fact that the standard deviation is lower, 10% for housing versus 22% equities, means that basically you have less chance of losing on real estate. And so your compounded return year over year is vastly better for the housing side of things and the real estate side of things versus equities. And so this is one of those things that I think we're all taught growing up, especially on the investing front, is generally we need to have higher risk to earn the higher return. And what this would suggest is, over this period of 145 years, real estate has performed better than equities with a less risky profile. So just an interesting data set. Again, not a silver bullet, but certainly a wide swath of data to base some considerations off of. Let's shift gears a little.
Yeah, Kris, I was going to add to that too. I remember hearing a presentation once a few years ago. They said, and then everybody kind of, the conventional wisdom is the stock market, or what returns maybe historically an average of 7-8% a year, something similar to that. But if you look at the history of the stock market in the 90+ years it's been in existence, the number of years it has returned between that 7 and 10% average return has only been like less than 10 of those 90 years. So other than that, it's been really high or really low, or people losing. So I think that points at least to what you're talking about with the volatility of that type of market versus what you see in real estate.
Yeah, it's a fair point, Scott, and I think it also speaks to timing the market is really challenging, right? Because if you had pulled your money out in some of those years where it was really high or really low, it's really hard to ostensibly, accumulate those gains when they happen, unless you're just in it for a long game. And look, me personally, I certainly bias towards real estate, but there's value in the market as well. I think it's just, a function of an overall strategy and how you should think about, your diversification across the board.
Absolutely, I agree 100%.
So let's shift gears a little bit, Scott, just from the historical return standpoint to some of the tax advantages to investing in real estate. And let me preface this by saying, if you are investing with your self-directed IRA, you're already reaping a huge tax benefit in that you've probably contributed those dollars pre-tax before income taxes, and then the dollars within your accounts obviously are growing tax-free. And at some point when you start to distribute those monies to yourself, obviously there'll be some taxable event, but the tax advantages of the IRA and qualified funds are strong already. And so a couple of these are really for thinking about more of a cash investment. And let's start with depreciation, because that's one that with your self-directed IRA or 401k, it may not be relevant to you, but I think relevant to the overall discussion on real estate. And for those of you not aware of how depreciation works, ostensibly the IRS just allows you to say that each year your property is worth less than it was the year before. And you can take that as a real tax loss on your tax return. So, if you think about it, your roof, your walls, your flooring, your lighting, your fixtures, all are worth less year over year. Just like, when you buy a new car and drive it off the lot, it's no longer new and it's automatically depreciated 20%. So same idea, but the IRS allows you to write that off as a loss. And so many times you can create a passive income stream from real estate, but that passive income stream is sheltered by the depreciation. So you can literally show a loss on your property to the IRS, but you are making money. So it's tax-free income. There's some vehicles that allow you to accelerate some of that depreciation as well. Things like bonus depreciation and cost segregation studies, which ostensibly just say, the IRS says, look, there are some things on your property that depreciate faster than a 27.5-year schedule will allow you to take those up front, right? So it may be depreciated over a 5-year schedule. And so it shows more loss up front. And many of our investors who come to us who have other passive income gains are using real estate as a depreciation tool to offset some of that income. So that's one way to maximize some of the tax efficiencies of real estate. The other is when you're selling these properties, hopefully for a profit, if you've held it for more than 12 months, generally your taxes are going to be accounted for on a long-term capital gains schedule versus an ordinary income schedule. And as of 2020, and certainly with the upcoming political environment we are in, this is subject to change, but long-term capital gains rates are between 0 and 20%, depending on your tax bracket. And so, even in the higher tax brackets of 15 or 20%, they're generally better than what an equivalent income tax on ordinary income would be for most accredited investors. So you can sell these properties at some point in the future and pay a much lower effective tax rate on those properties than you would if it was just coming through an ordinary income. And so a lot of investors like that. And then finally, kind of if you think of the tax advantages as a full cycle, for those of you who are not familiar, the 1031 exchange, in my opinion, is probably one of the greatest wealth preservation tools in the IRS tax code. Again, we'll see what happens with the upcoming political climate. I know certainly President-elect Biden has talked about rescinding the 1031 exchange, but it's been around for 100 years, and we'll see if they're able to get that done. But what it allows you to do is, as a real estate investor, you can sell your investment property, and any of those gains on the property, let's say you bought a property for 100 grand, you sold it for 200 grand, your gains of $100,000 in profit, you can exchange into a like-kind property. And so you can take that full $200,000, roll it into the next property, and not pay any income tax. And currently in the tax code, there is no limit to how many exchanges you can do. So we have many investors who, they call the strategy defer, defer, and die, where basically you continue to exchange, and when you pass away, the investment passes through to your estate with a step up in basis. Basically, the depreciation clock starts over again. So it's a really nice tool to preserve wealth. We work with a number of investors that do 1031 exchanges, and although complicated, there's certainly some work that goes into it. The tax benefits associated with it are pretty fantastic.
Hey, Kris, I've got a quick question for you, just maybe offhand. If I don't have a slide on this per se, but do you know kind of what percentage of your investors are using either an IRA or a 1031 for the tax advantages to invest with you?
Yeah, with us, and this is anecdotal, don't hold me to the exact percentage, but I would say generally in any of our offerings, there's about 20 to 30% of our investors who come in with IRA money. And sometimes, and let me take that back, a qualified fund. Sometimes that could be self-directed IRA, 401k, depending on how they have it set up on their side. But I would say generally between that 20 and 30% range is where we see it.
Okay, thanks.
Yep, my pleasure. So shifting away, if we're thinking about why real estate, another reason that a lot of investors come to real estate and specifically with us as well is they're looking for a non-correlated asset to invest in. And all that means is, when you think about correlation, a correlation of one means that, if one thing moves, the other thing moves. So a correlation to the stock market would mean if the stock market goes up, any investment goes up alongside of it, if it's a correlation of one. If it's non-correlated, it means the stock market can go up and down where the other asset is not tied to it at all. And there's an interesting study, it's referenced on the bottom there, done by MetLife, comparing US core real estate, kind of how it's done historically and for the future with their views. And they look at the correlation between real estate and a traditional equities market, specifically large cap stocks. And the correlation was 0.56 for real estate and 0.67 for government bonds. And so what that says is it's not very correlated. So core real estate is really a nice portfolio diversifier over a long-term hold, meaning, if the stock market goes up and down, Scott, as you had mentioned earlier, with those normal fluctuations, your valuation in real estate is not necessarily changing. Now, there are certainly events that cause values in real estate to go up and down, but not necessarily correlated with the ups and downs of the stock market. And then secondly, the chart that we have below there is just describing an income stream comparatively across multiple decades, the 80s, 90s, and 2000s. And what it's showing there is, you'll see that orange bar and yellow bar, the real estate income return. What it's providing is really nice, especially in the 90s and then again in the 2000s, some really nice income compared to, certainly the S&P dividend yield and then a 10-year treasury coupon. The income was much higher on the real estate side. So not only is it a nice non-correlated asset, but certainly a strong, consistent income stream over time. And so I think, that my goal with that is to give you some sense of why thinking about real estate is valuable. Let's shift into self-storage specifically. Certainly I'm biased as I'm the CIO of a self-storage operator. But what I would say is, there's really three things I'd like you to think about with storage and why it's a good investment opportunity. One being the historical performance, two, the downside protection, and we're certainly seeing that again with COVID. And then there's an interesting consolidation opportunity in the market that I'll share with you. And I think those are really the pillars of why self-storage. And then, many of our investors, obviously, with COVID being a devastating global pandemic in the last year, how has self-storage performed? So we'll touch base on that as well. Here's our three pillars, and the data set I'm referencing, you'll see the link on the bottom there. This is data from the National Association of REITs. And for those of you not aware, a REIT is just a real estate investment trust. And what it does is they track all of the publicly traded REITs in the marketplace across any asset class. So, apartment REITs, office retail REITs, self-storage REITs, timber REITs, agriculture. If there is a REIT, they track it. And it's a really nice data set because it gives you a long-term view. And so if you look at the last 25 years of performance, self-storage has done just under 17% a year, which is pretty incredible when you're comparing it to some of the other core four, more traditional asset classes like apartments that did just under 13%, retail 12, office 12, S&P 500 7. So, historically it's performed very well across the board as an investment class. And so, what I always think about next is, okay, historically it's done well, but what's going to happen in the next downturn? And so, we're not through COVID yet, but we can look back at the great financial crisis, 2007, 8, and 9, and see how storage did there comparatively to some of the other asset classes. And so through 2007, 8, and 9, storage lost less than 4% comparatively to apartments, closer to 7, retail 12, office 8, S&P 500 obviously got crushed. And so it had some really nice downside protection. And the reason is where demand for storage comes from. We talk about the 4 Ds of demand, and those are death, dislocation, downsizing, and divorce. And fortunately for our industry, unfortunately for the population, in the great financial crisis, there was obviously a lot of downsizing and dislocation. I can't speak to the divorce statistics. And again, even when people create that transition in their lives, it generates demand for self-storage. And what we're seeing with COVID is very similar, right? A lot of death, a lot of dislocation, not so much on the downsizing, but certainly people are moving, fleeing out of the major metropolitan areas. And interestingly, on the divorce, I have a friend whose father runs a very large divorce practice in New Jersey, and he's had the busiest year in the history of his practice. His point was, well, when you stick 2 people together that don't really like each other and stuff them in an apartment or a home for months on end, the divorce rate is going to rise. So that'll be an interesting demographic or effect of COVID that we'll see in the coming years. But generally, it's creating more demand for self-storage. So it has that nice downside protection. And then lastly, the market consolidation opportunity. So there are 5 publicly traded REITs in the space in self-storage. And if any of you are driving along the highway and you look off an exit ramp, you'll probably see one of them, Extra Space, Public Storage, Cube Smart. Those are some of the publicly traded REITs. And they own about 5%, or I'm sorry, about 20 to 25% of the market. And the remainder of ownership is very fragmented. And so our strategy at Reliant is really around a roll-up strategy where we're trying to consolidate a portfolio, and then we think about selling that to either the REITs, the larger REITs, which we've done a lot of, or to institutional capital like pension funds or insurance companies who are just looking for a yield. And so that consolidation opportunity, there's a lot of value if you're able to put together a portfolio level sale versus just onesie twosies. So again, Scott, I don't know if you had any specific questions, but these are kind of the 3 pillars of why self-storage. And then if you're okay with it, I can shift into what we've seen with self-storage through COVID.
Yeah, I don't have any specific questions yet. Again, I encourage anyone listening live to make sure you pop those into our question box. Yeah, I think it's interesting. Like one thing I think personally for me is kind of you've seen self-storage really be, I don't know if it's just more and more prevalent over the last years. Different in where I live here in the Tampa Bay area. You'll see an empty lot that's being developed, and it's another self-storage facility. It really is the demand for self-storage, I think, is something that really has increased over, I'm not sure if how to go back when you really start to see the turn, but it is something that seemingly is continuing to rise. People are needing space for their stuff, whether it's they're consolidating or they're, families are living together, people are moving, let's say a child is moving back home, they're moving a parent maybe into their house when they don't want to just get rid of all the stuff that they have, and it kind of allows them just to kick that can down the road and have a place to put their stuff for the time being. So again, if you have questions as we're going through the presentation, please ask them with Kris. I definitely want to hear kind of what you see as some potential, the good things going for the industry, and also the potential barriers or obstacles you might face going forward.
Yeah, for sure. Let's start with COVID, because I think that's obviously in the forefront of everyone's mind, and how self-storage has performed. And let me share with you that what I'm ostensibly sharing with you is the national view of this, right? Reliant has 50 properties, so we're across 8 states. So the lens at which we see the asset class is relatively small, but all the publicly traded REITs who have thousands of units across the country report their data, and it gives us a pretty good view as to what's happening across the asset class. And that's what I'll share with you now. What we've seen both in our own portfolio and then nationally is, April, May, and June were very quiet. I think as people were kind of coming to terms with what COVID is and how it was going to affect their lives, it was quiet and scary for many self-storage operators, because we saw a lot of traffic drop off. And then, as we went through July, August, and September, and coming into the fourth quarter, we really saw traffic pick up in the demand curve. And I think the demand curve grow. And I think what was happening is people were, figuring out that, hey, this is the new norm. I'm not going to die if I go outside. And they still had the demand for storage for the reasons we had just stated in the previous slides. And so we had a really strong Q3, as did the industry. Many of the operations have returned to normal in the third quarter. Fourth quarter numbers we're still finalizing, but it looks as if the fourth quarter was also really strong, except for a few markets where there was, there's still some really stringent lockdowns. Reliant operates primarily in secondary and tertiary markets where the lockdowns have not been as strict as maybe Manhattan or San Francisco. So, our particular properties have not been affected as much as some of the larger metropolitan areas. But generally, Q3 did the Q3 returns for the REITs. The returns were at 16.9% for the third quarter. And if you look down below on that chart, you'll see outperformed the S&P 500, some of the other industrial, healthcare, manufactured home REITs. You'll see that SNL US REIT Equity Index is sort of like an index fund of REITs. So it really outperformed. So we saw that across the board. And if you look below some of the asset classes in red, hotels obviously had a really tough time. Retail, shopping centers, office, multifamily in some cases. There's some that have performed really well. Malls, retail, those are the asset classes that have really gotten hurt through COVID. So, through Q3 and Q4, we've seen a strong bump up. And if you look at the last bullet point here, the 5 publicly traded REITs were up just over 8% year to date, where one of the largest REIT indexes was down close to 19%. So, comparative to the rest of the asset classes, storage has done well. And in our own portfolio, we've seen some specific metrics that would point to the same thing, with things like our delinquency rate is less than 1%. So that's tenants who are more than 30 days late on their rent. Most everyone is paying their rents. And collections have normalized for us. And auctions, maybe some listeners have seen Storage Wars, the TV show, and that is the auction process. When someone doesn't pay their rent, we essentially auction their unit off, and then we reimburse ourselves for any past due rents. We can't profit on it. Any profits on the unit go to the tenant. They have to go find the tenant and distribute the profits to them, but it does collateralize our rents with their goods. So that is returned to normal as well, where like multifamily, there's been a lot of eviction moratoriums, which has put a lot of stress on many properties. So far so good on the COVID side of things. And I think if
Kris,
yeah,
I'm interrupting you. We did have a couple of questions pop up. I want to make sure I get to these too while you're talking about this, and before you get into the tailwinds and headwinds. But someone just asked, we were talking about the national REITs. The REITs said with the results being discussed, it would seem that the REITs would buy up everything, I guess, in the realm of self-storage. Why haven't they? Maybe you can speak to what kind of REITs that the REITs have, I guess, in this industry, and why they're not just dominating the industry in general.
I think it's just a function of time. You're going to see a consolidation where the bigger get bigger as we go through time. The amount, you have to understand that the asset class is fairly immature compared to some of the more traditional asset classes like apartments or office or retail. Self-storage really was a very niche investment asset class 10 years ago. Maybe a little bit longer, 15 now, and really has come to the forefront in the last 10 years or so. And the REITs are consolidating. If you looked at that data 10 years ago, it was closer to 10%, and they are slowly buying up. If you look at the acquisition activity across the publicly traded REITs, they're very active in the space and will continue to be based on the cost of their capital because they have access to very cheap capital. So I think it's just a function of time, and that's part of the reason why we see that roll-up strategy as a finite window for us, right? Where we've sold probably in the last year close to $200 million to one of the REITs, CubeSmart, and they like the product we put together, but the risks that we'll take as an operator, they're not necessarily interested in. And we'll walk through a couple of the properties, how we look at properties, and how we build a business plan. And sometimes the REITs aren't willing to do what we'll do, and so we're kind of a middleman. We'll take that property, provide or add value to it, and then sell it to the REITs who are looking for more of a stabilized asset on their side of things.
Yeah, and Kris, I think that's what I was going to ask you. That makes sense. I was guessing that's what you all primarily do. It's you take it from a mom and pop where the property's at a certain level, either of maybe disrepair, needs some work on it to get it up to maybe a level that a company like CubeSmart or Public Storage would then say, yeah, we'll take that property on now as is, and they don't want to get involved in doing that kind of in between work. So, and we did have a couple of questions. We had two people, or same person asked a question about where the property is located. We're going to talk about that in just a minute, so make sure we let that individual know to ask that questions. But if you want to go ahead and continue, Kris, and then get into kind of some of the properties that you all have been involved in and what you've done to get those properties ready to sell.
Yeah, for sure. So let me just give you a little perspective on what we think our tailwinds and headwinds are going into 2021 and beyond, and then we'll share with you kind of a vehicle we've used with our investors in the past and some of the properties that we look at in the business plan, so you can understand how we view the investment side of the business. Tailwinds, we touched on it. Occupancy is up over 200 basis points across the portfolio, which is a really nice number when you think about 50 properties due to that increased demand we already discussed. We did touch on the collections and auctions have normalized, delinquency rate less than 1%. Rental rate increases have also normalized, as well as the rates that we're charging on the street are up year over year over the same period of time in 2019. So, through 2020, even though we had that blip with COVID, the rental rates that are being charged are above where they were in 2019, which is pretty incredible when you think about what's happening, at a global scale right now. Keep in mind, leases are 30 days. So we have the ability to move rental rates very quickly up and down to potential consumers of self-storage, because it's only a 30-day lease versus an apartment where you have 12 months, which is great. It locks you into that income for 12 months, but it makes it a slower process to sort of change any of the revenue stream, good or bad, to the property. I think the headwinds, Scott, you touched on it, right? You're seeing a lot of new supply coming to the market, new facilities getting built. And I would say that this was the #1 risk for us pre-COVID, and it's become the #1 risk for us post-COVID as well. Markets that have seen a lot of new development, especially the top 50 markets across the country, because storage has performed so well historically. I'm not the only one showing you this data. There's a lot of people who've invested in storage in the last 10 years because of how well that it's performed. And so when you add new supply to a market, it's basic economics, right? Where, if supply goes up, then, generally prices are going down as people are trying to get those buildings filled. And so for us, that's our #1 concern, is the market that we look at. And when we buy a property, where we're going into and what the potential new supply could be. And then also, interestingly, because of COVID, we've seen an increase in some very large investment activity, very large transactions in the last, call it, quarter to 6 months. Again, because self-storage has proved itself as recession resilient, there's a lot of interest from big institutional capital to join the space. Blackstone just bought a portfolio called Simply Self-Storage for $1.2 billion. Cascade is another group that made a large investment. They have, the splash there was they have money from Bill and Melinda Gates. And so, everybody said Bill Gates is investing in storage. Not exactly, but certainly it's a good headline for people. So that increased investment activity is driving prices up, right? There's a lot of interest in the asset class, so we have to be really thoughtful that we're not buying above the market. And then, look, generally, we're not 100%. We're recording this in the beginning of January. The outcomes of COVID-19 have not been determined yet. And so does that equate to any changes in behavior? We don't know, and certainly we'll be watching that very closely in 2021 and beyond. And so, Scott, I'm going to shift gears a little bit and just share with the group a little bit more about how we, this is a vehicle that we use with our investors to purchase properties. It's called Reliant Self-Storage Fund 2. And this fund is basically a mutual fund of self-storage properties where you invest at the fund level, and then we buy a portfolio of properties, so you earn that diversification. And the goal in sharing it with you is to share the types of markets that we're working on, and then the business plans of those particular properties, so you can see when we say value add and self-storage, what that means. Does that sound fair?
Yeah, that sounds good. In fact, I had a question kind of talking here. Somebody asked, are your deals 100% equity, or do you take on debt as well?
No, we lever all of our deals somewhere between the neighborhood of 65 to 70%. We'll put a loan on these facilities. We'll raise the additional equity and the debt, and that makes up our stack, our capital stack for the purchase of the property.
Okay. Yeah. So yeah, like I said, somebody had asked about the different locations. Obviously, you're going to get into that now. So yeah, let's hear about the different kind of the properties you've done and how you've done it.
For sure. So what I would say is, geographically, we're trying to create diversification in the fund. So Our properties today, the 50 properties we own, are spread across primarily the Southeast. This particular fund has 7 properties in it right now, or will have by the end of Q1. And we're spread those 7 properties across 4 states. 2 are in Illinois, just outside of Chicago, 2 in North Carolina, 2 in Georgia, 1 in Florida. And the idea behind this, right, is if one particular market gets hit with some sort of catastrophe, let's say a hurricane wipes out a town, you as an investor are diversified in that there are 6 other properties in different states, different markets that hopefully buoy the performance of it, where if you were just invested in that one property, you may have a much larger impact. So let's start with 2 properties that are closed in the fund right now. One is in East Denali, Georgia. And East Denali is a little town on the border of Georgia and South Carolina, certainly a tertiary market. And this is a mom and pop owned facility. So this gentleman who built it back in 2006 owns the facility. That's the only one he owned. He built it himself and did 4 expansions over the years, and each time leased them up to 90+%. And it's a great indicator for the demand in the market. He sold the facility, and our business plan here is to add a couple things. One, we're going to put a shovel in the ground and build some additional boat and RV parking. So not storage traditionally as you'd think about it, but think that covered pavilion style parking. This property is right next to Lake Hartwell, which is a very large body of water in South Carolina and Georgia. And we're trying to take advantage of that boat and RV traffic demand. He just never did it. And when we looked at some of the parking available in the market, it's very limited. So we think there's a nice opportunity for us there. So we're going to build 24,000 square feet of parking. We're also going to add a U-Haul truck rental program, which is a nice ancillary income item, as well as a tenant insurance program, which is just tenant insurance is we insure the building and all the grounds, anything in the units, you insure. So it gives you a sense of the types of value adds we're doing. Here, we're not only putting a shovel in the ground, but also adding some of those ancillary items. Second property that's in the fund is in Wilmington, North Carolina. And this property was actually built in 2018 and leased up very quickly because of how it's positioned in the market. And our business plan here, you'll see when we underwrote it, we underwrote it at 82% occupied. As of last week, this property was 97% full, which we would argue is too full. We want our properties to stabilize around 88%. If it's more than that, it means that your rents are too low. We're always trying to balance the economic occupancy with the physical occupancy. And so as occupancy goes up, we're going to raise rates a little bit and see if we can push additional revenues until we meet that balance. So our business plan here, because of the demand that we believe is in the market, you'll see we're going to build an additional 12,000 square feet of climate controlled, or just under 12,000 square feet of climate controlled and drive-up units behind the building that currently exists. And the value add play is getting that leased up and then the additional revenue associated with it. So gives you a sense of the market. And again, here we're going to do an expansion to create additional value at the property. This is another property we'll close on in mid-March in Statesboro, Georgia, the home of Georgia Southern for you football fans there. But this is a stabilized asset, so it's 96% full. We're not going to do any expansion here. All we're doing is adding some additional ancillary income items, the things we already talked about: U-Haul truck rental, tenant insurance program, point of sale, think like locks, boxes, retail items. And so, this is a property where we don't see a lot of new development going in. The population growth has been really strong and it's undersupplied. And then also they've been charging less than market rates on one of the most popular unit types, a 10 by 10 climate control. It's 17% below market. So we feel like we can bring that up to market rates and grow revenue. But this is a stabilized asset that really we're making some minor changes on to grow revenue at the facility. And then lastly, I'm going to share this property with you in Midland, North Carolina. This is a property about 16 miles east of Charlotte. And, again, a value add deal where it's currently, historically has been 90+% occupied. The current owner built an expansion that opened in October, and they're down to in the mid 80s right now because they opened up all those new units. And what's interesting is if you look at the picture here where all this parking is, we're going to put an additional climate control building here. And the reason why is there's only 2 facilities in the market that offer climate control. And what climate control literally is just an air conditioned or heated garage versus just a non-air conditioned heated garage. So those 2 climate control facilities in the market are 100% full. So we feel like there's some unmet demand there. So we're going to build out some additional expansion and then also add those, you'll kind of sound like a repeating record here, the point of sale items, U-Haul truck rental, tenant insurance. This is a facility that, again, mom and pop owned. They actually run it from their house. So there's no one on site, which is really low hanging fruit, we think. And then secondly, where it's positioned, as Charlotte continues to grow, we're hoping that this product will be in the path of progress and become a much more desirable area. Within a mile of facility, they're building another 129 homes. So it's definitely on a growth path. And then, during the hold period, we expect Charlotte to push out this way. So just wanted to give you a sense of the types of properties and the business plans that we're working on. And 2 of the properties that I had mentioned are already closed, just to give you a sense of how storage has performed during the summer months. This is just showing you occupancy, revenue, and net operating income, the projected versus what we're seeing actual on these 2 properties. And this is through November of 2020. We don't have December's numbers finalized yet, but you'll see we're outperforming in all 3 categories. So we're really encouraged by the performance of the asset class through the summer months. So with that, Scott, I'll kind of turn it back over to you to any other questions that we may have. I think our goal of, is to share, more information with you on self-storage and why we think it's a great asset class, real estate on a whole, and some of the advantages to investing in real estate. And, if anybody has any questions, my email address is right there. Certainly you can look at our website, reliantinvestments.com. It'll have more information on us as a firm, our current investment offerings, and happy to answer any questions that we may have right now, Scott.
Yeah, thanks, Kris. And great presentation, great information. We do have a couple of questions to get to kind of in general self-storage, and people did have a few questions on the fund a little bit that we can ask. So one of the questions, you mentioned the renter insurance product. The question was asked, is that voluntary for somebody who is one of your tenants, or because does it put the fund storage business owner at a disadvantage price-wise compared to your competitors, I guess, if it wasn't voluntary, if it was mandatory?
So almost all facilities, certainly institutional quality or institutional managed facilities, have a tenant insurance program because it's a liability for the owner, right? So if let's say, God forbid, a building burnt down and Scott, your stuff was in it and not insured, you're coming to us for some sort of, remuneration for those lost goods. And so I would argue that it's industry standard for most professionally managed facilities to have some component of tenant insurance. Actually, our lease requires it. When you sign up for a lease, either you have to bring a deck page from your homeowner's policy or renter's policy showing that these goods are covered, or you're automatically signed up for it. And I would say across the industry, most operators are doing that because as an owner, you don't want to have that liability if, grandma's stuff burns down in a fire and then you're concerned that, or you're coming to Reliant saying, hey, you got to pay for this. So just something to consider, but generally it's an industry norm.
Another question someone has, do you ever, all the examples you've shown are at least in one of the examples you're saying you're going to actually, or a couple of them, you're going to build some new self-storage. Does Reliant ever go in and just look for raw land to build new self-storage? And if so, how much land would you require for that type? And maybe you could just say, if you don't do that, maybe roughly how big the self-storage facilities are with the surrounding, land around it as well.
Yeah, so I would say that what you're describing is ground up development, which we've certainly done in the past. We are not a developer by trade. It's not the only thing we do. Our sweet spot really has been value add plays in secondary and tertiary markets. We're obviously not afraid of construction. We have an internal project management team, and on most of our projects, we're doing some sort of construction. But development for us, it's really got to be a home run. We're generally 1 or 2 development deals a year at the most. So yes, indeed, we have done ground up development. In this particular fund, there are no ground up development deals that we see in our pipeline right now. That could change. But generally, development deals are a risky proposition. There's a lot of upside for sure. But for us, we do a very limited amount of ground up development.
So yeah, so I have a couple questions people are asking about investing and what's involved. And again, just want to preface that with, again, make sure you do your due diligence if you're someone listening to the call on Reliant. But a couple of questions here. Are equity investors ever subject to any capital calls in your deals?
Yeah, it's a great question. So historically, in the properties that we have owned thus far, we've never made an investor capital call. And we do, in our documents, when you sign the documents, it's an obligation, not a right. So what happens is, and for those people not familiar with a capital call, basically that means if the property's in trouble and we need to raise additional money to keep the property from being foreclosed on to the bank, for example. Well, we can go out to investors and say, hey guys, we need, I'm making up a number, another $1 million to keep this thing afloat. And the investors can choose whether or not they want to invest in that or not, right? If they choose not to, us as the manager do have the ability to go out and raise capital at our discretion and potentially dilute you as an investor. So it gives us the ultimate decision-making ability on, hey, if it's a property that we think, ran into some trouble, but long-term is going to be okay, we can make that decision, go raise additional capital and potentially dilute you. But historically, we've never done that, but the documents do allow us the opportunity if we need to.
Yeah, and a couple of people asked about the amounts needed to invest, and do you have to be accredited or not? We don't necessarily have to go into those full definitions of what that is, but do you have a minimum investment typically for different deals or different funds that you have?
We do. So basically, to answer the question around the accreditation, yes, you do have to be accredited. This is called a Reg D, SEC Reg D offering, and it's specifically a 506C. And so that requires all the investors to be accredited. For those of you guys not familiar, accredited means you either have income of over 200 grand or $300,000 if you're filing singly or joint, or you have a net worth of over $1 million, not including your primary residence. So that's what the SEC designates as accredited. And so, for example, all our investors in Fund 2 are accredited. And generally, it depends on the deal, but generally our minimum investment is $50,000.
Okay, and then questions, I guess, a little bit. Maybe we can wrap up on this too, as well as we're getting close to a little over on the time. But questions kind of on. Well, someone asked if say a buyer, a REIT comes in and wants to buy up one of the properties, are the funds then from that purchase returned to investors, or is it then reinvested? And then along with that, what is the typical hold period for some of your the facilities that you acquire?
Yeah, it's a great question. And for those investors interested in the actual investment opportunity, our website, or you can email me, I'd be happy to send along an investment summary that breaks down that structure. But to the question around the sale of the property, yeah, it absolutely is returned to investors. So we set up what's called a preferred return. So meaning in our particular fund, it's an 8% preferred return. And what that means is all monies from the fund go to the investors until we meet that threshold. And when we sell a property, any profits go to catch up that preferred return first, and then return 100% of the principal to you, the investor. And then it gets split, based on a waterfall. So, maybe 70% to you, the investor, and 30% to us, Reliant. So the incentives are aligned in that we have to hit a preferred return 100% of your principal, then we get to share in the profits of the deal.
Yeah, okay, and then let me again ask, what is a typical, I guess, hold period, I guess, or maybe what's it for an investor? What is it? Do you have a typical timeline that people, or is it a 3-year commitment, 5-year, 10-year, kind of how does that work for an investor who's coming in? How long do they expect to have their monies locked up?
Yeah, that's a great question. So like Fund 2 is projected to be a 6-year hold. I would say, that 5 to 7-year window is generally what we project. Now, if you go back to our track record, we've sold 22 properties in just over 3.25 years. So we've been able to speed that up. But as investors, in these passive syndications, Scott, I think, whether it's with us or another operator, I think investors should be confident or should have the expectation that, there is no liquidity in these investments, right? So when you invest, you're really at the will of the operator to determine when those funds get turned around. And look, sometimes it can be sooner than projected, but sometimes it can also be longer. And there is no way to get out ostensibly until they sell the portfolio, or in our case, sell the fund portfolio. So, people just need to be comfortable with that illiquidity of the particular investment. And that's why sometimes self-directed IRA investing is so good, especially for younger people who are saying, look, I can't touch this money for 20 years anyways. Having it locked up for 5 years is perfectly fine.
Yeah, you took the words out of my mouth on that one. I was going to mention that one of the reasons I think a lot of times that IRAs are popular in these types of investments, self-storage or multifamily or private funds, is a lot of people look at their IRAs as something they're not touching for 15, 20 years, maybe even more than that anyhow. And it's the last source of funds they're going to go to any kind of emergency. So some people don't mind locking it up. And the returns that you pay, the returns from a fund, do you pay those typically quarterly, yearly? Just curious kind of what that looks like from an investor, or is it just kind of at the end?
No, we make distributions generally on a quarterly basis. So every 90 days, it's 30 days post quarter close that those distributions are made. And with the self-directed IRA custodians, generally we're direct depositing that right back into your IRA account. And so if there's a refinance or anything along those lines, Scott, we put those monies back into the account. When we sell, it goes back into your IRA account.
Gotcha. Well, Kris, I'm kind of out of time here. Again, if anyone else has any additional questions for Kris, either on what's involved with self-storage and how you get involved, you have more questions for him about Reliant and what they do and what they look for in acquiring these properties, please reach out to him. His phone number is here on this slide, as well as his email. Kris, if you can afterwards, I had a couple of people asking for the slide deck. If you can send me what the deck is that you use, we'll make sure that we get that emailed out to everybody along with the recording as well. So again, thank you very much again for your time today. Do you have any parting thoughts or comments to share with everyone who's listening?
No, I appreciate everyone's time and sticking with us. I mean, the thing that I would say is I think evaluating real estate as part of your investment strategy, specifically through self-directed IRAs, is a fantastic way to think about it. And depending on your overall goals, a good way to help you get there. And happy to answer any other questions that you guys may have in regards to self-storage or any of our investment opportunities.
Good. Well, Kris, thank you very much again. Again, if you have any questions, please reach out to Kris at Reliant. And I want to thank everybody for attending today. Bye.